when are the best deals going to happen in the Seattle Metro? Right now.
So, man, what a crazy year.
Understatement.
Totally. Would you have thought going into January, February, March that the market would be in the state it is now?
No way.
And why not?
Because, so I love stats, and we've been tracking numbers, since 2003 in relation to real estate. And never in history have you seen prices change and depreciate and compress and basically just go down in a low supply environment.
Totally. I mean, needless to say, I think the last few years we saw some unprecedented times, right? And it's interesting that we always joke about this, how everyone's become an economist.
Yep.
I think part of that is technology, social media, but also the things happening at those higher levels are affecting us more than ever.
We have to pay attention.
Totally. And that's why I'm excited to talk about this with you, about the state of real estate in 2022 and where we're going in 2023. Because even though there's a saying that somebody said, William Goldman, a writer of Butch Cassidy and the Sundance Kid, said, nobody really knows anything, right? Because the future is affected by so many variables. But if you're a professional in the industry, if you're doing this every single day and you're honest with yourself and you're looking at the data, you can at least kind of know what direction we're heading without knowing the exact destination.
Absolutely.
So my first question for you, and I got my own thoughts as well, what is the state of real estate in 2022 and where are we in December in relation to what just happened?
The state of real estate is, we went on a ride, and I mean, that was a rocket shooting straight up.
Yeah.
And then the Fed decided we've got to cool this rocket off. The Fed starts raising interest rates in March. So our bidding wars in the Seattle Metro, we peak in kind of, that March, April time. And instantly as those interest rates come up, the market starts transitioning. There was like an overnight cooling effect that instantly happened. And so as that cooling effect happened, what happened is we started to see price compression because of how quickly the Fed raised rates. They raised them the fastest they have ever raised them in the history of the Federal Reserve.
What does that mean? The Fed's raised rates. What are those rates?
So the Fed fund rate was sitting essentially at zero. Right? And then in March, the Fed started raising that. What happens is real estate survives on 30-year debt. Okay. So as that 30-year mortgage goes up, and at the beginning of 2022, we were sitting at right around 3%. And then that rate was pulled all the way up to like 7.25. That's huge increase.
Crazy.
And I mean, I did go through some specific numbers, and I have to look down to actually read this. If you had a $600,000 property and we were at 3% at the beginning of the year, 5% down, 1% in taxes, $75 a month for homeowners insurance, plus your mortgage insurance, because remember, this is only 5% down. That payment in January was $3,472 a month. That payment peaked out last month at 7.25, everything else the same, $4,957. That's almost $5K. Like, that's a ridiculous amount of money. That's $1,485 more per month for the exact same house.
And one thing I bring up though is it's not necessarily the exact same house, because from January to whatever the peak was, would it be April or May?
Yep.
House prices continued to go up,
yes, sir.
right?
Yeah.
And so you were actually getting a smaller house at one point with a higher interest rate and paying more money monthly. And that is just crazy because no one understands that.
It went up, it peaked at, in May or June, or April, depending on where you're at inside the metro, right? And from there, it has compressed all the way back down to where Pierce County is still doing very well. Like, Pierce County is beating everyone, probably because of affordability. King County's got like 0.1. And then Snohomish County is like 2.4 right now. So overall, the whole metro is still positive, even though we've seen price compression. Well, how much have we seen? You've seen anywhere from 20 to 18%, and it's not quite depreciation yet, it's price compression, just go away. So yeah, literally up, and then, you ever been on a roller coaster at like Six Flags?
Oh yeah, love them.
And you hit the top and you're looking down? That's what the market did, and then just
How many people do you think realize how bad real estate is in terms of its pace?
I think that real estate is such a local market that it depends very specifically on which market you're in. I'm in the Seattle metro, and we're one of the biggest affected markets. Okay, and we're moving the fastest. This doesn't mean this is the same throughout all of the U.S. Okay, so this is the fastest price compression or drop in history, but we also had the most up. So if you have the most up, you got to have the most down.
Yeah.
Okay, when things change. Where is it going from here? You're probably going to see another 5 to 10% down in 2023 in our area. I mean, that it just has to do that. So you will see depreciation in 2023.
And what about interest rates?
Interest rates, we're massive debate, right? So this is a roll of the dice to see where you think it's personally going. Interest rates may have already peaked. So interest rates are very much go off of inflation and the Fed fund rate and expectations. Now, in addition to all that, all of these mortgage origination companies, they actually built in extra margin. So normally speaking, there is a 1.5 to 2% kind of basis point. So 150 to 200 basis points between the low rate and the rate that they're given. Well, that spread got as big as 350 basis points. So part of what you saw and the reason rates peaked at 7.25 and they're coming down right now is the market's starting to calm down because the Fed is slowing down. And so that compression is already starting to happen. And there's still more compression that can be built into the market. So there was some people on, the internet, the YouTubes, that they said rates are going to 10. I never quite felt that way, but for a moment you're like, man, we could hit 9.
Oh my gosh.
We could hit 8. And now that the Fed has started slowing down, I think if we do go back up, we'll peak out in the low to mid 7s. However, I would say there's probably a larger chance that we stay in the 6s. And then sometime in 23 that the rates start to float back down. I'm thinking third or fourth quarter, we go into the low 6s, high 5s.
Of 2023.
Of 2023,
Right.
Correct, sir.
To finish that first answer about the state of real estate in 2022, how are we ending this year? Where are we at October, November, and December? And what is the market like right now in wintertime?
So the market always slows down in the winter. It always calms down. We always have less inventory. Okay. And what the news likes to do is they like to over exaggerate those points and those statistics. So the market, though, is, and this is nationally, not just Seattle, is definitely cooling off faster, more price compression than normal. So throughout the Seattle metro, transactions are down right now around 50%. Transactions in the U.S. are down around 20%. I think one of the reasons that we're getting hit harder is we are also a tech mecca here in Seattle. And I mean, you've seen the headlines. What happened to Meta, Google, Microsoft? They're all having these layoffs. And if they're having layoffs in the Seattle metro, and these are high-paying tech jobs, well, that affects the market. So you've got a double whammy. You've got, tech pulling back and real estate pulling back, and we're both of those markets. So I think we're getting an over-exaggeration. P.S. You're also seeing this in places like Austin, San Francisco, other tech meccas too.
Yeah. Wintertime is interesting this year more so than ever because not only did you have the normal seasonal effects, but you were coming off that roller coaster you're talking
Bingo.
about, right? And we all know that even though the top can be scary and that's where you kind of feel those butterflies,
Yep.
it's the worst near the bottom, right? Like it obviously eventually slows down, but from the data, it seems like with that, I mean, let's just talk about that for a second. 50%
Yes.
less listings.
No, actual closed sales 50%
So explain
less.
that specifically, what that means, like why that's significant.
If in December of 21 you did, let's call it 8,000 transactions throughout the Seattle metro, that means in December of 22 you're doing 4,000.
Yeah.
That's what that means. That is such a huge drop. Nationally, we were doing over 6 million transactions. NAR's numbers just came out this week. It came in actually a little lower than expectations, and we're coming in at a run rate of like 4.09 million. So that's still, so on a national level, that's 2 million transactions going away. Huge numbers. When I say things like that, I think a lot of people get doom and gloom. Change in any market creates massive opportunity for you if you're willing to deal with the change and find the opportunity inside of that specific change.
Yeah, I'm excited to talk about that. I do have one curious question for you. 50% drop in transactions means 50% less actual closed
Yes.
sales of
Yes.
property. We went from 3% in the beginning of the year in terms of 30-year interest rates, all the way to 7%, and now
7.25.
7.25, and now it's like at 6.5.
When I looked this morning, it was, I wrote it down in my notes, 6.25 this morning.
Okay, 6, which is still double what it was at the beginning.
More
right?
than double, yes.
Is this similar to what happened in 2008? Yes, no, why?
No.
And tell us why. Because people are comparing it to that, but this is why I think this discussion needs to be had and more people need to understand this, because we're in a whole different ballgame right now.
So the history repeats itself and history rhymes, but it doesn't mean it's always the same thing. So in 2003, 4, 5, 6, P.S. I was in real estate then, and we had ninja loans. No income, no job, no qualification, just lie and we'll give you a big bag of money. You can buy a house. That everything changed. Like everything changed. So during the last financial crisis, AKA the Great Recession, we made it so buyers had to qualify. Buyers had to have down payments. Buyers had to have jobs. And one of the reasons that crash got so bad is anytime you really ramp up the qualifying ability and you lower the criteria, you steal buyers from the future and you pull them into today. All the buyers over the last few years have qualified. They've had real down payments. They've had real jobs. Okay. Second, the vast majority of homes throughout the US have equity. So even if the market drops 20%, 30%, we still have equity. The financial crisis was led not only by those bad loans, but it was also led on the packaging of those bad loans and selling them off as good paper. Well, banking has gotten a lot more, hey, so what's in that loan over there? Prove it to me. And so the mortgage-backed securities market is now a lot more clear than it was before too. Before, what happened was you could take a HELOC out on a house and you could leverage it over 100% of value. You can't take a HELOC out like that today, a home equity line of credit. So we just have all these factors that are preventing people from actually over leveraging. And then once again, a lot of people have equity. And based on the current rate of the market, even if the market depreciates another 10, 20%, the vast majority of people would still have equity. During the last crash, and you know this, you saw us do a lot of it, we worked for 54 different financial institutions. Today, I have one bank-owned property. I had 8 requests for price opinions in December.
So less foreclosures,
Way
less bank-owned properties. I mean, it's almost like non-existent, right?
The foreclosure rate in the U.S. and here in the state of Washington is the lowest it's been in 20 years. And Washington is like number 48th on the foreclosure list. For perspective, in 2009, my company did $129,000 in BPOs at 35 to 50 bucks a pop. So we were doing hundreds of them a month. In December, we got 8. Also, at the peak of the financial crisis, at one point, we had 144 active listings, and we had another 110 in the hopper, just in some phase of foreclosure. Once again, I have 1 today. Can it get worse than this? Absolutely. But even if it did 5x where it's at, 10x where it's at, we're still not going to be back to where we were before. The other big part of why this is different is here in the Seattle Metro, we had a bunch of local banks, and those local banks were giving out easy money to builders and developers. So just like, if you were a home buyer or you were a small investor, you could over leverage. Well, guess what? The big builders, developers, they could over leverage too. And so they did. And you could basically finance at 100% loan to value.
Now or back then?
Back then,
Yeah.
in the previous crash. Today, you can finance at 75% loan to cost. So there's such a larger margin for builders and developers in there that as prices compress and come down, there's still a margin of safety for them to be either able to sell their product or to be able to just hold it and keep it. So what's happening is, one, we did lose a lot of builders here in the Seattle Metro, and they haven't come back. So 2008, 9, 10, 11, and 12, we just didn't build enough homes. Then we started really ramping up construction. And then areas like in Texas and in Utah, they got definitely some oversupply. We don't have that here. But with that, even them coming back like gangbusters, we didn't have as many builders as before. We didn't have as many developers. And it cost them just plain more money. And then all of a sudden, this market cycle stops. Well, and they're all slowing down again. So any way we look at it, in the next 24 months, we're running into another supply issue. We have to.
So the difference from 2008 to now, a lot of people would call this another crash,
Yep.
right? To a certain degree,
It is.
It totally is a crash.
Let's just call it a crash.
Right?
It is.
It's just not as devastating to the system
Yes.
as it was before. And my perspective is you don't know the root cause of it as a normal consumer. Because back then, all the reports are banks are failing, right?
Yes.
Houses are going into foreclosure. People are losing their homes, and the market is flooded with properties, with listings, right? For sale. I remember walking or driving for sale signs everywhere.
Yep.
Right now, the financial system is healthy, even though interest rates are higher,
Yep.
right? People have equity, even though they are losing it
Yep.
right, in their homes, meaning they have, price, adjustment space. And there's not as many listings out there. Yet, why is it that we have experienced, depending on your market, anywhere from 10 to 20% drop in prices, and we're going to continue seeing a drop in prices if there isn't enough inventory, and ultimately there's still people that want to buy?
Sheer affordability. It's the example we talked about earlier. The payment was approximately $3,500, and it now is approximately $5,000 for the same house. That cuts out a lot of affordability all across America. And once again, we were talking about a $600,000 house in that example. That lack of affordability, what it does is it puts massive pressure on the seller, okay? Because how many buyers do you know that can just fork out an extra $1,500 a month?
Not very many.
So that buyer pool shrinks dramatically. Some estimates are the buyer pool is down to 25% of what it just was. So as that buyer pool shrinks, the seller has to become more motivated. So sellers are doing price reductions, they're buying down people's interest rates, they're buying closing costs, and ultimately having to reduce their price in order to compensate for this massive difference in payment.
So part of the price drop, it's a necessary part of the nature of real estate, right? To balance things out.
Supply and demand.
To make it affordable, but it's still not affordable, like for most families, especially if we're looking at a recession. And so my last question before we talk about advice for buyers and sellers, my last question is, if we know that houses are still not affordable and that interest rates, actually, that's another question before you answer that. Interest rates probably aren't going to go massively down for quite a while. I want to know, like, for how long. Then it's, to me, seems reasonable to forecast a bigger drop in house prices till we become affordable. Or do people just stop buying houses?
Neither. And the simple answer is that the U.S., except for in a couple places, is still behind on housing from 2008. So there's just going to be this constant lack of supply. And so it will be affordable to someone, just not a large majority. The second part of this is actually a larger policy problem. Affordability and the American dream of homeownership is under attack by zoning, land use, energy efficiency, regulations, red tape. The Master Builders Association here in the state of Washington did some research, and they said that 28% of the price of a home, so almost a third, was in relation to zoning, land use, red tape, development. The U.S. as a whole, and then on the local level, our cities and our governments, they have to fundamentally look themselves in the mirror to attack this affordability problem and create avenues for builders, developers, and investors to create an affordable product. If they don't, we won't have affordable real estate. So it's a policy issue, one, and it's also a supply issue, two, because 2008, 9, 10, 11, and 12, we just didn't build stuff. You know, as the market was crashing and all these builders are going out of business and developers are going out of business, imagine being the builder that walks into the bank and goes, "Hey, can I have a loan?" No.
Totally. To me, another perspective I have being part of that last crash, right? It just takes a few years to figure everything out.
Yes.
Banks have to come back and be stronger. Consumers have to have confidence that they're not going to go belly up or that their neighborhood's all going to drop in prices. And the system just has to get going. It's just like anything that gets revved up too high and breaks, takes time to repair it. We're doing the same thing. Like, it was only inevitable. Maybe no one could have foreseen this happening in this way, but it was inevitable after, we haven't even talked about this, right?
Yes.
A pandemic.
Yes.
Whether you believe it was super extreme or not as bad, it definitely affected the whole world.
It happened regardless.
Yes. The lockdown, right? Almost every single country to a certain degree, different degrees, of course, right? People not working, right? Or working differently. And then just all the consequences of this, supply chain issues.
Supply chains getting
right?
pinched.
People migrating to cities. Like, I wonder if this was the biggest migration of humans in the history of mankind.
I don't know the answer to that.
So
what I do know from the data, though, this is the largest migration that we've had in decades, where people have decided, I'm leaving X metro, I'm going to the suburbs, the burbs, or even a rural environment because I want to get free. I want to take, control of my life, or I want to feel safe. One thing that's maybe added to the fuel of this housing market was that the pandemic happens and you're stuck indoors and you're told what to do. And then all of a sudden you get free, so you get this taste of freedom. And then the work from home movement starts. So it allows people who are generally commuting over long periods of time to move to the suburbs or maybe even to another state and work in their house. So you see Boise explode, you see places in Texas explode, Colorado, Montana, places, just massive influxes of people. Then to top it all off, what they did was the Federal Reserve lowered interest rates, and they created the cheapest debt ever. If you've been locked indoors, and now I said you were told you could work somewhere else, and so you've got this freedom. I'm free.
You're moving from the Bay Area where prices were ridiculous to like a South Dakota where it was like clearance to you.
I could come in and just pay cash.
Which was happening.
Which was what was happening. What happened then, all of a sudden, the real estate market had that fear of missing out because everyone was doing it. So everyone started jumping in. So, all markets, stock markets, real estate market, whatever, they respond to this emotion in a massive way. So part of this it was, yes, massively cheap money, but it was just emotion of humans. Hey, you were told to do something and hold still, then you were set free. And so the emotion was like, oh, well, my best friend's buying a house. I got to go buy a house. Or my best friend just moved, out of the Bay Area to Colorado. I got to move to Colorado. I think there was a lot of emotion in this market. So part of what they're doing is they're just trying to cool down the emotion of the market by making debt more expensive.
Now, we know that, based off that quote I gave earlier, that nobody really knows anything. There's no way someone's going to predict the future 100% accurately.
We don't have crystal balls.
Exactly. There are those people, though, that do make good calls.
Yes.
They also probably make bad calls once in a while.
Yeah.
So I want to ask you to put your crystal ball hat on.
You want to put me on the spot?
Exactly, right? What do you foresee happening in 2023? And then let's get into advice for buyers and sellers alike.
Yeah. There are about, matter of fact, I literally wrote it down. Morgan Stanley, Zonda, KPMG, John Burns Real Estate, Moody's, Goldman Sachs, Pantheon Macronomics, Redfin, Capital Economics, Wells Fargo, Fannie Mae, Amherst, ING, Zelman and Associates. All those people predict the market's going to go down. There's like a handful of people that predict the market's going to go up. CoreLogic, Realtor.com, they might be biased. And they only predict a small rise. Out of that group, collectively, it ranges from 2% to a 20% drop. There's very few people sitting at that 20%. I would say the vast majority range in that 4 to 10%. And there's some amazing minds at these companies. For us in the Seattle Metro, I really agree. I think you're going to see another 5 to 10%. What does that mean? Like, how do I just wrap my brain around this? So 2022, let's call it a goose egg. That appreciation's gone.
Yeah.
Okay. Take away half of 2021, and that's probably where we're going to land. Is that a bad thing? Absolutely not. Because if you look at 18, 19, 20, 21, 22, and you take away, somewhere between 20 to 25% of that appreciation, you're still massively ahead. Who cares? What happens, though, is consumers, we get a lot of fear. So realize in the Great Recession here in the Seattle Metro, we dropped 41%, the largest drop ever. Well, what happened in other recessions? Sideways, no growth. We grew as much as 7%. We grew 4%, and 1 went down. So out of the last 6, you only had 2 that went down, and the rest were like flat or slightly up. Okay? This one, we're going down. Okay. Why? Because whatever's a rocket that shoots up, whenever it runs out of fuel, it's got to float back down. There's my thoughts on the area.
I agree. I have a different perspective, and maybe not to be alarmist, but I believe it's going to be worse. And this is why. I agree that we're going to go down in prices for, the house values, because the number one question people have, no matter what time period, is how much is my monthly payment?
Yes.
And that's why this recession or this price drop year is so significant, because the interest rates are so high compared to
just what they were.
Recent history, right? And for so long, even. I mean, we're talking not just the last 3 years in terms of pandemic shutdowns, but even prior to that, they were so low. So that takes some adjusting.
We have to get real specific, and if you want to go look at this data, go look at the Federal Reserve's interest rate graph. For 40 years, interest rates have gone down.
Yeah.
And what happens is, as a consumer, we have a short window in our mind, right? So for us, 3 and 4% mortgages is what they should be.
Yep.
Really, over the last 20 years, it's like 6.
If we know interest rates aren't going to be coming down dramatically, that's where the crystal ball comes in, right? We don't know how fast the Federal Reserve is going to stop raising rates and then 2, drop rates. That could be 6-8 months from now. It could be 2 years out. But we know for sure it's not going to go back down to 3 anytime soon.
No.
And it probably won't even see the light of day below that for a very long time. So I feel like the next 1, 2, or 3 years, no matter what actually happens, similar to 2008, it's going to be another year to 3 years of figuring it all out. There's just too many variables we just can't predict that are going to create a challenging circumstance for everybody. And, to me, it makes sense, get into the house building game. I mean, we're not even going to start talking about lumber prices, right? There's certain costs that are coming down. Why aren't there more builders building? But the point I'm trying to make is, just like back in 2008, think about this. How many more properties would we have bought if we knew what would happen, right? I mean, everyone was kind of scared. Everyone's kind of waiting, okay, what's the next guy going to do? So with that being said, and you can either reply to that, or what's your advice to people that are selling properties in the next to 1 to 2 years?
And I think, so I look at this data all the time, every day. And I think the consumer generally gets more afraid than they need to. Let's just go back to the last recession. You wouldn't believe the amount of people I told them, just keep your house. Because technically they could afford it. That what they were doing was there was fear, and that fear, the same emotion that was flying the market up, well, back in 2008, 9, and 10 was just driving it down. It technically didn't have to really go that far. Not most people, a good portion of people should have probably just kept the home. Okay. Second, I know it feels rough right now, but I believe what the Federal Reserve is saying to us is also a bit of rhetoric, because the Federal Reserve only has 2 things they can do to control inflation: the actual Fed fund rate or monetary policy, and then their voice. And so when the Fed stops raising rates, which I believe we're going to get a quarter in February, a quarter in March, and then a quarter in April, and they're probably going to then stop. Once they stop, that's going to create a level of market stability where that price spread that lenders charge will start compressing, because the fear starts to leave the market. And as that fear starts to leave the market will start to get a solid footing. So just to give my rough prediction, I think 3rd or 4th quarter of 23, the market's going to start to find the solid footing. I'm talking in the Seattle metro now. And then I think by mid 24, you'll start to see appreciation. So then what buyers say is, well, when should I buy? Okay. The stats and the data on this are really weird. In the last recession, because we played a lot in the last recession, we were investing and also doing bank-owned properties and things like that all at the same time. In the last recession, so once again, in the Seattle area, it started for us in 2008, and then basically like the rest of the country, 2009. That was the actual recession. The rest of the country was 2007 to 2009. The best deals, though, if you're looking at original list to sales price. So original list to sales price is what the buyer got off the original listing price. Happened in 2009 and 2011. So people say, I want to wait for the market to bottom before I buy. Statistically speaking, the best deals are actually happening as it's still trending down, because there's more fear, which is more opportunity. Then what happened in our area is that last set of deals happened in 11. 2012, we got footing, and then 2013, we started going back up again. When are the best deals going to happen in the Seattle metro? Right now. And they're going to continue right now through maybe middle of next year to 3rd quarter of next year. How do we know the market stopped? When's the opportune time to buy? There's no specific time to buy, and it really depends on your goals if it's a buyer or an investor. But there's like a set of indicators that you can watch. 1, when the Fed stops raising rates. 2, when days on market in your local area stops going up and plateaus. Days on market is just how long it takes to sell a home. When listing inventory supply goes flat or stops increasing. When building permit applications start going up. When bankruptcies and foreclosure notices stay flat or start going down. And last but not least, because this one is the absolute most important when we're talking about deals, when the original list to sales price ratio starts returning to its historical norm. There are areas in our metro already, and these are the affordable areas, that's the key part, where you can see that starting to return to its historical norm. Now, we're not going to know if that's a trend for 3 months or 6 months. But if that starts to pop back up and it goes to kind of that 98% range, you're there. It's the bottom. You don't know it's the bottom until you pass. So you can't give someone financial advice like today is the day to buy. It depends on your goals, your family, your situation. Okay. Best deals though, probably over the next 6 to 9 months.
Buyers, average family, going to buy their first home. They're very price sensitive to that monthly payment, right?
Yes.
Considering the interest rates. What's your advice for them? This is just where they're going to live. Go ahead.
I'm going to give you an example. So we just sold a first-time home buyer a couple of weeks ago. This first-time home buyer would have never even survived the last, 2.5 years before that. The seller would have laughed at their offer and said, "Where's my $100,000 earnest money and my free Tesla?" Okay. The buyer got $25,000 off the list price. We got the seller to pay 6% in closing costs. So the buyer had to come up with their FHA 3.5% down. Their closing cost, which was about 3% down, was paid for by the seller. And 3% was then used to buy down their interest rate. That buyer got a deal that they couldn't have got over the last 2.5 years today because no one else was making that offer. And in all bluntness, they actually weren't even that well qualified. This wasn't like phenomenal 750 credit score.
Cash.
No, this was also around the median price range for the area. So there was competition. There was other people looking at it. If you can, just go get a deal. But you have to make sure you're getting a deal. A deal is a deal in any market, regardless if the market's shooting up, flat, sideways, whatever, it's a deal. Well, how do I know if it's a deal? Why don't you start knowing your market? Write some things down. Track the market. Follow the market. And if you follow the market for 60 days, or if you work with an awesome real estate professional that does something like that, they can show you, oh, look, this one's a deal. Quick tip to identify deals. Look for the price per square foot. Price per square foot is a quick, simple way to create maybe 10 suspects that may be a deal in your market.
I would give advice to anybody buying a house right now, first-time home buyers, make ridiculous offers. And I used to be a real estate professional, used to be an agent. Yep. So I understand on that side of things, there's a mutual respect, but nobody is going to work harder for a deal than yourself. And we're in a buyer's market where you're going to not only be allowed to do that, it's necessary if you want to make a deal. So, of course, there's amazing real estate agents like yourself, right, that know what they're doing. I would say because we're on the downturn side, it's okay to make these offers, because what I remember in 2009, 10, and 11, ridiculous offers are being made and they were being accepted. Yeah.
Well, with the one we just talked about, the person got $25,000 off of a $625,000 house. Okay, so that's about 5%. So even if the market dropped 5%, they're still golden, number one. Number two, they got their interest rate bought down. Number three, they got their closing costs paid. Like, that's a deal. Okay, so get a deal in the market. And maybe to flip this over on the seller side, like you asked, For a seller, this is not the I want to sell because I think it would be fun to upgrade market. This is the market for the motivated seller who wants to take advantage or needs to take advantage of it. The problem the seller is going to run into, and what we're calling them, is interest rate hostages. And interest rate hostage is I have a 3% mortgage and now I've got to get a 6%. And mentally, that's a hard jump for me to make. Also, even though I have equity, my equity isn't going to go as far because of that change in payment. So for the seller, if you don't have to sell right now and you have a longer than 3-year time horizon, like a 3, 4, 5-year time horizon, this may be the market to wait. Now, once again, you're going to have to evaluate it locally based on your numbers and your situation. But if you're a seller that needs to move in the next 24 months, you need to go yesterday. Okay. Now, if you're the seller looking to sell their expensive home and maybe downgrade to a smaller home, that upper end of the market's getting hurt worse than the affordable market. Once again, it probably makes sense. Sell the more expensive home, go buy the other one. If you're selling something around the median price and you can get a good deal, maybe you found a builder you can get a good deal from because he's got to unload a bunch of inventory, or a seller that, they can't live in Washington anymore, they got to relocate to the East Coast, where there's some sort of motivation, you may give up something on your sales side, but you'll turn around and make it up on the buyer side. So you need to just make sure you're working with an absolutely amazing, talented real estate broker who's going to make that make financial sense for you and your family. Otherwise, you really need to wait.
So sellers, if you don't have to sell, don't sell, because the market, think about 2008 to whenever it came back, it will come back eventually. That's the nice thing about real estate. Everyone, especially now, needs a house, right? There's the shortage of them. So we'll come back maybe sooner than even you and I are predicting. But if you have to sell, rip that Band-Aid off and don't be afraid to be realistic about the sale price. This is not the days where people I think I'm going to get 100,000 over, or I'm going to get $1 million for something that's going to really sell for 800,000.
No.
You can't live in la la land right now as a seller. So to me, it's not like there's not a lot of gray area. It's one extreme or the other.
One extreme or the other, unless you have very specific goals and you can figure out methods of accomplishing that. Once again, I'm just using this example, but we have a seller who's going to sell around the median price and they're going to go buy something from a builder. It's a phenomenal transaction because they're moving into a much larger home. The price per square foot on the new construction is amazing. So that's a deal. Once again, if it's a deal, do it. If you can't make a deal, it might be time to wait. Also, I think for sellers that are on the market right now, they have to kind of get real. And what I mean by that is you have to decide, am I willing to drop my price in order to obtain a sale? This is a bouncing ball rolling down a hill. The only way to get in front of that ball is you've got to run out, jump in front of it, and stop it. Which means if your neighbor, there may or may not be one up here on the hill that one of our buyers made an offer on, that the neighbor sold for the $725 around the price of they're at. In today's market, that home is only worth $685, $700. That seller has to do a price drop. Otherwise, they're just going to have to keep it or rent it. Second, if you're on the market and your agent is not having these discussions with you, they probably weren't here in the last market. They don't know how to have these price discussions and explain what's happening. They're afraid to just be blunt. This is not the market where you want your agent to fluff you. You want your agent to just be clinical, to the point. This is what you need to do, how you need to do it, where you need to do it. Let's get it done.
Offend you now so it doesn't get more offensive later.
Exactly. Rip the Band-Aid off. And then lastly, I think if your property is sitting on the market and the agent's not asking you for price reductions in today's market, they're doing you a disservice. If your home is not selling and you're in a metro like ours that has low inventory and your home's in good condition and it's properly marketed, then it's just overpriced. I know we don't like that. Emotionally, we don't like that. I mean, because I'm a seller too. I mean, I'm selling properties right now and I don't like some of the prices I'm personally getting for my own investments. But the reality is I'd rather take it, get the money, roll into the next thing.
There you go. Well, what's the topic next podcast?
Next podcast, let's talk about how this relates specifically to investors.
Sweet. I'm excited. So how can people find you if they want to work with you?
RESG.com, that's our main website. And you can just go right there and you'll be able to find us. You can find me on, Instagram, YouTube, Smoke Signal, Carrier Pigeon, whatever works.
Email works too. So, all right. Well, I'm excited for the next one.
All right. Thank you, sir.